Is market volatility, costs and regulatory changes, a pragmatic approach to clearing members' day-to-day challenges. Presenting on this, we have two speakers, both coming from SLIB. The first is Anne Job de las Cathas, who's the Risk Product Marketing Manager. Her expertise lies in the area of risk, especially in clearing and counterparty risk, with 20 years of experience as a senior consultant, functional architect, product owner in financial institutions such as SocGen and CIC Securities. She's currently working as a product marketing manager at SLIB and driving an innovative revamping of the credit risk product line. She graduated from the Institut d'Études Politiques de Lyon, excuse my pronunciation, and has a postgraduate diploma in organization and protection of IT systems. Presenting with her is Jean-Eric Camusset, who's a sales director at SLIB. He has a proven track record of over 30 years in business unit management, sales management, and financial services, both in Europe and APAC. He joined SLIB 18 months ago and heads the distribution team as the Senior Vice President of Sales. So I believe we have you both on the line now.
Yes. Hello, do you hear me?
Yes, we can. So I can hear you, Anne, and do we have Jean-Eric as well? I think you're muted.
Can you hear me better now?
Yes, we can. So I can hear and see you both, and I can see your presentation. So I will hand over to you two now.
Thank you. Thank you. So welcome everyone, and many thanks for attending this session today. And today we are going to talk about risk management for sure, and more specifically about market volatility, cost pressure, and regulation. Well, first and foremost, let me wish you a good afternoon or a good morning, maybe. Well, since according to a friend of mine, it cannot be afternoon before we lunch. Well, anyway, so as has been said, my name is Jean-Eric Camusset, and I am part of SLIB Executive Committee. Today's presentation will be divided into two parts. The first one, when I'm gonna say a few words about SLIB, and then I will hand over to Anne, our risk product manager. So first, who is SLIB? So SLIB is definitely a software vendor delivering a cloud-based solution in a pay-as-you-go SaaS model. And what are our solutions? Basically, we have two main lines of business. The first one is digital voting, where our software enables our clients to deal with work council, general meetings, associations, and so on and so forth. And in particular, we service listed companies enabling their shareholders anywhere in Europe to vote anytime with any type of device on any general meeting. But our primary market is the security services market, where our core business is predominantly made of post-trade services, but also risk management solution. As part of this meeting, we will try to shed light on the challenges clearance brokers are facing and how we can contribute to alleviate their pain points. Which pain points? Well, for sure, 2020-21 pain points, so pandemic pain points, where in the context of this pandemic, the market experienced an increased volatility and quite a few margin spikes, but also the long-term market trends. I mean, the necessity to deliver operational efficiency in an always improved value for money. But at the same time, the unlimited creativity of the regulator, in particular in the risk framework domain. To that purpose, I'm thrilled to introduce you Anne Job, who is our risk product manager. Anne, the floor is yours.
Thank you, Jean-Eric. Good morning, everybody. Thank you for joining. Yes, Jean-Eric, I confirm we work in permanent dialogue with our clients that in a area of risk, of course, are, let's say, tier 1 clearing members and clearing members as well of a lesser size, like individual clearing brokers. And their activity is in majority located in Western Europe, Central Europe, and Asia as well. And I would like to confirm it's striking how some key concerns are to be heard of by discussing with every one of the clearing officers and from one clearing officer to the other.
Lovely, Anne. Let's crack on then. As already said, we are working in the risk market for quite a few years now, and we have been meeting and keep on meeting quite a few market players. Today, we have decided to share with you what they say. Well, nobody can afford staying blind intraday is one of the most frequent sentences we have heard and the most frequent challenges they need to cope with. Anne, over to you.
Yes, in terms of feedback, this one is one of the most frequent indeed. So it's related, I must say, with the 2020 market events that were extensively described by Anton just before this morning. So the expressed need here is that until now, to cover the market activity, some clearers were finding that end-of-day computation was sufficient to perform a margin computation against their final clients. But the last market crisis, yes, proved an evolution in this domain. And now they say to us, we cannot stay blind along the day. There are two reasons for that. First of all, increased pressure to produce an internal reporting to the hierarchy, to be able, from a clearing officer, to be able to confirm to the hierarchy promptly if one broker, so an end client, is able to overcome the market volatility. Let's remind that last year in March 2020, the equity volatility was multiplied by 6, for example. So if he were able to cope with that, or if there an additional margin to be taken, or other appropriate actions that could be taken to mitigate risks. So, for example, we had the Archegos case that was described this morning. And this thing we have heard of a lot last month is confirmed by a 2019 Deloitte survey that was carried out and showing that for 83% of the risk practitioners that were asked, they say that they were ill-equipped to perform intraday supervision. So, in fact, being able to have fresh computation, fresh view of risks is in fact not enough. There is an additional need that is clear to make quick decisions. It's not relying only on fresh data. These data, they need as well to be consolidated. So here, there is a challenge.
Yeah, I feel like the challenge here is stemming from the diversity of their activities. The clearers offer services like settlement of uncleared activity, clearing activities from several CCPs, and so on and so forth. Are we on the same page, Anne?
Yes, we are. And as well, there is the settlement of the uncleared activity as well, and the redelivery of broker trades, even in cleared environment. So this was confirmed in 2020 survey made by Sealant, and the first concern of the majority of the respondents related to risk affecting and how COVID-19 is affecting the pillars of risks. And the clients and the respondents of this survey were reporting that the first concern for them was a fragmentation of the data, so the ability to consolidate information in an efficient manner to be able to make quick and appropriate decisions. So a good, let's say, summary for that is that would be to say that the system should be more agile, simpler, holistic, and customer-centric to be able to offer to risk officers and risk practitioners monitoring tool that would enable them again to make great reportings, appropriate reportings in a timely manner. So those monitoring tools, they will have several challenges. The first of them is to be able to adapt to legacy systems that will be most of time fragmented due to the diversity of the activity. That implies to be able to offer a multi-format acquisition layer to be able to consolidate heterogeneous activities. In fact, this heterogeneity will lie in several aspects. The first, heterogeneity of sources of information, fragmentation of legacy systems, and as well the nature of the data that need to be consolidated. We can need to compute exposure, but being able as well to consolidate these figures with pre-computed figures that might be provided either by CCPs themselves or external or alternative algorithms. And last but not least, those data shall be provided by external systems at different frequency. So this means that a monitoring tool that should be accurate and allowing everybody to have a consolidated cockpit, enabling them to monitor properly exposure of brokers in, let's say, very troubled time, means being able to conciliate all this heterogeneity of data.
Thank you, Anne. Let's quote another one. I want my clients to see what I see. What does it mean?
Well, actually, here, the expressed need is all about transparency. A clearer needs to show to its end clients the way he computes his margin. So it's a question of credibility, a question of trust of relationship they have built together along the years. And it's all the more important in a tense context when margins are rising.
Well, transparency sounds an amazing objective from a marketing perspective, but how do you envision to implement it? And is it really what the market players are after?
In fact, what they say is we need to communicate easily. We need to be reactive upon exposure alerts. We need to investigate. We need to justify. So that can be obvious in tense market condition, of course, but it can be as well needed. And I would say even all the more in normal market conditions when a margin spike should be justified by looking for a typical position and being able to isolate some position amongst thousands of them, and to be able to make a, let's say, accurate diagnosis of potential computation or market data issues, and all this in no time. So practically, the solution here, it lies in new technology, in the ability to search in huge amount of data. So in big data technology, I would say. So ergonomy will demand graphic investigation tools. So the ability to go really quickly straight to the point and to build flexible reports that would fit to the client's needs. So even at the extreme, being able, through open architectures and appropriate confidentiality, the ability to share screens with clients and build dynamic reports that the client might be able to investigate by themselves.
Very clear. Let's pick the next one. I want to go to bed peacefully. Well, to be honest with you, Anne, I'm a bit puzzled since I feel personally very peaceful when I go to bed. So why are they nervous from your perspective?
It's striking how this sentence was quoted several times and in several languages. So what do they say? They say in the morning, I have 2 hours to fund the margin calls, and the end clients, they have the same issue, the same perspective. So here, the need expressed behind is the ability to anticipate margin spikes. So despite CCP margin frameworks are supposed to limit procyclicality, it's not completely possible to avoid margin spikes as they are the reflect of the behavior of the markets. So even if IOSCO and principle of financial market infrastructure put a very high priority on procyclicality limitation, this anticipation needs is key. And this needs, it exists in the 2 directions, from the clearer against the CCP and from the brokers against the clearers. So there are 2 stakes in this needs. The first stake is a financial one. When, let's say, spikes cannot be clearly anticipated and in appropriate time, this means being able to leave high buffers of liquidities at the CCP / at the clearers, and to avoid to immobilize for 2 days of exceptions in the year high buffered deposits. The ability to anticipate will allow a clearer, for example, to be less conservative in the deposit he leaves at the TCPs, because he will be able to anticipate and be able to fund, let's say, soon enough spikes that can be expected from the market. So have a less conservative behavior against the CCP itself, but as well against his client.
You mean that the message you want to get across here is that anticipation goes with competitivity, correct?
Correct, exactly. It's a question of commercial competitivity as well, from one client to the clearer to the other, the ability to demand potentially less high buffers, so to be able to, you know, to make the broker more comfortable and demand less liquidity. So that was the first aspect of this issue. But the second stake is an operational one. Margin funding is to be done in constrained times. So cutoff need to be respected. So what is key? A key improvement is to be able to know 1 day before, so in the evening, what will be the call of the next end of the day, in fact. And pragmatically, this solution can be found by running a daily margin algorithm based on the evening position that are not quite the end of day position that are reported the next day by the CCP, but to have an estimation of the next margin call to come. So this can be performed by connection to computation service of the CCP if it exists, if it's available, and if it can be plugged on the system in an industrial manner. The second one is to run a replicated margin algorithm that will allow the margin to be anticipated, and the clearer in that perspective to anticipate at the end of the day, but at D-Day, the amount of the margin, then do the appropriate actions to fund this margin call, and thus go to bed in peace.
Well, thank you. Well, I like the following one. And Excel can jeopardize our margining process. Well, soon it sounds like a joke.
Yeah, but it's not. It's not at all. So in fact, here the need that is expressed lies in the vulnerabilities of the architecture of the legacy systems. So as we discussed just before, the legacy systems that might be fragmented everywhere, and the need is to be able to consolidate information from one, let's say, one activity to the other that is most of time ensured by one piece of the IT infrastructure to the other one. So, and most of time what we are reported is that there is a lack of flexibility to be able to collect everything and consolidate. And this needs to heavy transverse internal projects to consolidate and collect everything and report it in an appropriate cockpit. Then what happens, what I saw several times, it leads to lasting short-term solutions. That is to say, a macro-based process is built to collect everything, to consolidate, and in addition to that, you have manual operations, and those short-term solutions, most of the time, they last. And they last until the moment where either internal audit or external audit will demand the clearer to remedy the situation. So this was not only what we get as practitioners and in the dialogue with the clearers, but it's as well confirmed by a survey we found that was carried out 2019 by Deloitte, that was confirming that 68 of risk professionals that were responding were considering operational efficiency as a priority.
Well, yes, but at the same time,
yes, go ahead.
No, I was saying that at the same time, we know that risk is no longer a magic spell to get budget.
Yes, yes, and even if the needs of automation, industrialization of process is acknowledged at the highest level of hierarchy, it remains that profitability of clearing activity remains, it's under pressure just now. So the costs of IT projects, so the entry costs as well as maintenance, are considered as a main criterion by for system changes. So that was clearly confirmed in a Bob's Guide survey, where 50% of respondents were saying that yes, even if we were considering risk mitigation projects and risk-oriented innovations, then it remained that entry costs were very, very focused. In fact, so here, the solution, I would say, is probably a solution that have to be sourced off the shelf, externalized, provided they remain agile. So probably as well cloud-based, to be able to be scalable regarding to activity peaks, particularly, and this is probably the best way to reduce their TCO.
Okay, very clear. And next quote represents definitely an additional complexity, and we are meant to perform contradictory margin computations.
Yes, and the expressed need behind is that CCP margin algorithm may represent an additional constraint for clearers, depending on what their supervisory authority requires from them. So, of course, the ESMA guidelines were requesting CCPs to provide and to publish documentation clear enough and transparent enough to enable the clearing members to replicate the algorithms. But it means, indeed, it gives heterogeneity homogeneous results. So in terms of documentation labels, in terms of availability, and it's the same for simulation tools that are not necessarily industrial APIs and necessarily available. And in any case, if contradictory computation is demanded, it means that the clearers shouldn't use the CCP's tools or the CCP's APIs that are made available to them and that cannot be considered as contradictory computation, of course.
Well, and we are used to talk to the clearing houses and we understand their way of working, and we can definitely translate their algorithm into up and running solutions.
Yes, and we can confirm that now there are upcoming additional challenges for clearers because the algorithms are rising in terms of complexity in numbers of indicator types to capture the adverse effects that are not directly related to the market. For example, the wrong way risk that will capture the correlation between positions and the clearers themselves, and the liquidity add-ons as well that are not only related to the market moves, but as well as the size of the positions that are taken by the different stakeholders. And in the third point, so last but not least, the move from span to span 2. So from, let's say, rather analytic methodology, risk methodology, to portfolio-based methodology, VAR-based methodology. So, of course, this new methodology, SPAN2 and assimilate VAR-based methodology have a lot of benefits. They will capture better the correlations between the portfolio. They will offer more transparency, predictability, as they are auto-calibrated. And they are open to cross-margining as well, diversification. And this cross-margining is very useful in a context where multi-asset strategies are increasing, of course. But this lead to implementation costs increase as the span are more centralized, standardized, and the SPAN2 will, let's say, disclose more complexity. And in particular, this complexity that is disclosed is highly related to the way that the CCPs are going to deal with procyclicality. For example, for historical filter simulation, there are 4 ways to reduce procyclicality, and from one CCP to the other, it can be a combination of these 4 ways. So, first of all, history depth. So you can go from 4 to 10 years of history depth of margin risk factors. You can complete your historical simulation with a stressed period choice. So this stressed period can differ from one CCP to the other, or from one business line to the other, of course. Third, you can floor the initial margin, and the way you floor it will be different, of course. And you can complete your VAR indicators with expected shortfall, for example. So this leads, and you can do as well a combination of the 4. So this leads to a diversity of approach from one CCP to the other that can be fully legitimate, but that will lead from a great move from a standardized approach, that is the historical span approach, to, let's say, a more diverse, a more complex approach of margining, daily margin for the clearers. And this will need to additional costs for the clearer as well.
So you mentioned cost, additional cost increase. Can you clarify what these costs are?
Yes. So when you're working with historical simulation-based indicators, you will need to source your risk factors time series. So that's not free. That can be rather, let's say, expensive. Second, you will have to perform a data cleansing. And for example, you have to manage the corporate actions. If you take the example of equities, you will have the splits and mergers and name changes and dividends, etc. You will have to work on your time series to perform a historical simulation computation. Then those methodology are more demanding in computation resources, and it will need as well an additional algorithm expertise that is not necessarily there everywhere at the clearing members, in the clearing members IT departments. So those additional costs and additional complexity might be okay to deal with for Tier 1 members. And this additional costs might be absorbed. But for smaller players, we talked to several of them, and it can be, let's say, a showstopper. It can jeopardize their economical model that is already, just as we said before, already under pressure.
Well, Annie, you mentioned quite a few challenges in the beginning of that presentation. But do you think the clearers can take advantage of those challenges, and to what extent?
In fact, when you are forced, when you are constrained to use a contradictory computation, let's say at the moment, to turn that into an opportunity to create added value services and refine the approach you have with your clients. So, for example, you will be able to simulate new clients' portfolios. And for example, for their new trades, you will be able to offer what-if services. That is to say, you inject a trade you intend to do, and you are able to, let's say, evaluate the impact on the whole portfolio of this trade. So be able to see if additional margin will be required for to cover this trade, or if it will decrease due to the diversification effect, if it will decrease the exposure of the portfolio. It can happen as well. And it can lead to another kind of service that would be related to collateral optimization. That is to say, you take the portfolio of the broker and you inject the collateral portfolio in the trade portfolio, and you hold this, and all this consolidated will result in the real exposure you have against your broker. And this might lead to a less conservative approach, as you won't have to apply, I would say, haircut-based methodology that necessarily will be more conservative, as it will cut each position individually.
Okay, thank you, Anne. But time is flying, and we will have to wrap up, since we are the last obstacle between the attendees and their lunch. So, Anne, if I say that then there's a will, there's a way, but it's more achievable with our solutions, would you tend to concur?
I would. So, in fact, To put it in a nutshell, what is at stake? The clearers, they face a tricky conundrum. On the one hand, market volatility is a clear incentive to reactivity, and these events we have passed through since 2 years, 1.5 years now, highlights the need to generalize functionalities that were not available everywhere. Let's say were not available at every clearers and in every IT infrastructure, I would say. So in addition, we have the need of compliance to those margining frameworks of CCP that time after time are moving in a great movement from span to span 2. And it raises the questions of more sophisticated and more expensive risk computation. So that's, let's say, the side of needs. And on the other hand, the global economic constraints will always push downwards the available budgets for IT investments, even if they are key to reduce the operational risks, and that can be they can carry as well innovation. So clearly, the way out, it cannot be anymore one more Excel macro to face this. And to keep the TCO under control, we believe that the solution, in the contrary, is to find an external resource instead of, building an additional Excel macro on a hidden place of the IT environments. So this external resource, they can satisfy the needs of expertise and of compliance. And these off-the-shelf solutions, they can offer to clearers the benefit of mutualized investments and roadmaps, in particular when the algorithms are getting more and more complex. And this all will work, of course, if these solutions are smart and flexible enough to adapt to their legacy system. And in that context, this is all the more valuable as well if the solution are cloud-based operated solutions, as they will be more flexible and scalable. And as we have seen, the volumes are on the market are really subject to move, and dramatically. So here, a pay-as-you-grow price model can be completely pertinent and completely accurate. So of course, we're here to discuss all these solutions with the clearers that can be a bit challenged at the moment to face all this. Thank you for that.
Thank you very much. I hopefully it was clear enough. It's time for the questions now.
Yes, thank you very much, both of you. We do have a few questions from the audience. So I'll start with the first one. All CCPs send daily margin requirements on quite common margin indicators like IM, VM, and add-ons. Where does the heterogeneity lie?
So in fact, basically, IM and VM and have the same meaning, have the same target. So VM basically corresponds to P&L and IM to potential future loss, of course. But if you look further into the detail, you see that those indicators might be computed in a very different way from one, let's say one CCP to the other. In particular, the IM, as I just explained before, the IM can rely on different methodology that all tend to capture potential future loss, of course, but the way to get it is strongly different from one CCP to the other based on those span approach or this VAR approach. And the VAR itself can be either historical simulation, but for some of the CCPs might be a Monte Carlo, Monte Carlo one as well. So as you see, this can be kind of tricky for clearers that are active in different CCPs. And the add-ons as well, as explained just before, so the wrong way risk or the liquidity related add-ons can differ strongly from one CCP to the other, and some add-ons as well are not necessarily supposed to exist from one CCP to the other. So there is no standardized approach in the detail. So when you have to manage the exposure of your clients from one market, one activity to the other, you have to consolidate you have to consolidate equivalent indicators and additional indicators as well that are not necessarily the same, that do not necessarily overlap.
Okay, fantastic. Thank you very much. The next question that we have is, how can you conciliate private algorithms and clearinghouse algorithms to perform daily margin computations?
So here it's a question of centralized monitoring, in particular for clearers that are active in several CCPs. So if they want to monitor the broker's activity across different markets and CCPs, they have on the one hand several margins that are computed by the several CCPs, but they would need to have as well a unique computation to consolidate the portfolio of their brokers across the different markets. So here it's no question of algorithm replication that is not necessarily appropriate to monitor all the activity, but more to have one private algorithm that will run on the global portfolio. And in that particular moment, when you will produce an alternative computation to the margin indicators that are produced by the CCP, you will have to put in place a clearing margining formula that will compare the clearing indicators, the clearing exposure that is materialized in the margin requirements on the one side, but you will have to compare that with what you produce as an indicator, as some markets and some CCPs will demand you to call not less than what they would apply in their particular case. So you will have a tricky margin formula that will first compare, second apply some minimums that are based on the algorithm of the CCPs, and third, to compare the whole result of what you have computed with your private algorithm, to compare that to the sum of what is requested by the CCP. So a rather tricky, let's say, exercise that can be done, that can be set up really, that can easily perform once you have clarified what are the requests and what are the needs of each CCP.
Okay, thank you very much. And I think we've got time for one final question, which is more agile, simple, and holistic and customer-centric. How can these benefits be provided by an external off-the-shelf solution?
Yes, it can be rather counterintuitive to say that an external off-the-shelf solution can be simpler and customer-centric than an internal one. But anyway, it's the fact, and that's what we see every day. The ability to collect heterogeneous data sources, heterogeneous figures from let's say, fragmented information system in the same entity. Let's say on a rather surprising way, it can be better performed by a totally external system that will be able to collect and consolidate by an agile acquisition layer, and push all this in a holistic single data mart that will feed flexible reportings based on modern technologies. And last but not least, an external system, in particular if cloud-based, can be able to face higher volumes, higher volatility, and will be able to tailor completely the consummation, the pricing of the solution regarding the level of the activity. And in that perspective, you will have more agile and more simple, as you will have, let's say, a more pay-as-you-grow economic model, in fact, and you will reduce your fixed costs.
Okay, thank you very much for taking the time to answer all three questions. And I think that takes us to the end of the